don't go chasing the latest fad in investing. Now, here at Falcon Wealth Advisors, we're not going to sit on our hands. We're always looking for, to upgrade
Of
our
course.
process or whatever we're doing, but we're also not silly enough that we're going to go just chase whatever's new and shiny object is out there. So,
Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
welcome back to Upticks with Jake and Cory. Cory, welcome back to the show.
Jake, thank you for having me.
Do you have anything new or exciting you want to share with today's audience, Cory?
Yes, this past weekend, Jake, I took my parents to a comedy show. We saw Jerry Seinfeld and Jim Gaffigan, and it was great. I don't know if there was anybody else out there who's watching or listening that went in Kansas City on Saturday night, but the show was
Who was
amazing.
better? Who was better, Jerry Seinfeld or Gaffigan?
My opinion, Jerry Seinfeld.
Yeah, I'm not a big Gaffigan fan. I don't think he's that funny.
His live show is great, and I've actually always been a fan, but his was not. That wasn't the main reason I wanted to go.
I like Jerry Seinfeld better. I think he's funny. Now, I haven't seen any of his comedy like you did. So, was it PG or was it rated R? I see those guys as a couple PG guys.
I would
What'd you
say
give it?
PG-13. Some of it was
PG-13.
R-rated. Yeah, some of it was R-rated. It was what I appreciated though, Jake, and actually the truth is that, both of the comedians, especially in 2025, when we're recording this and when we went and saw the show, I feel like their sort of reliance upon everything in the modern world wasn't so much there. Like it was all very entertaining without bringing politics or all of the other stuff that frankly seems like it kind of creeps into, culturally to a
Oh,
lot of
yeah.
things. Like it just made it that much funnier that they didn't have to lean into the political environment to still be comedic, if that makes sense.
I appreciate comedic. Look at you. That's a fancy word.
That's right.
I appreciate, I watched Saturday Night Live this weekend and
Beautiful words right here, Jake. Thanks to you.
did I get you that book?
Yeah,
I think I
Jake,
did,
you gave me this book after teasing me for my vocabulary. 500 beautiful words that I should know.
Comedic. I watched Saturday Night Live this weekend and Dave Chappelle, which I don't think my wife likes him. I think he's funny, but you're right. He has gone so overboard with controversy that he has to talk about controversy now. People expect it.
Yeah.
And I think that's a shame. He's a great comedian. I think he's funny, but I think it's not necessary what he does. He's funny. But
Right.
anyways, so good. I know we had a couple of things on here. I want to bring up mine. We're recording this before the Chiefs have played Buffalo in the playoffs. It'll probably be out right before the game. So my question to you is, Cory, are the Chiefs going to go to the Super Bowl?
Yes.
Yes. And are they going to win said Super Bowl?
Yes.
You know who I'm rooting for the Chiefs to play in the Super Bowl?
Who's that?
Washington.
That's what I thought you might say. Yes.
Yeah, Washington has this rookie quarterback. So for those that haven't followed the NFC,
Right.
which I don't follow the NFC much, good for him. He beat the Lions, which was the best team, I think, in the NFC. And I would really love to see the Chiefs and what used to be the Redskins play in the Super Bowl. I think that'd be really cool. Of course, I want the Chiefs.
This is the first year that the Commanders too, Jake. It is interesting that they're having all the success, and it's right after the ownership sold the team. Like new ownership this year, rookie quarterback, and all of a sudden they're in the NFC Championship game.
Good leadership, Cory.
Yep.
Goes back to leadership. Speaking of leadership, I also wanted to announce today, Cory, we got a new teammate.
Yes.
Today is Catalina Florez's first day. Please, everyone out there, help me welcome Catalina to our team. Catalina will be serving as my executive assistant, so I'm real excited to have her join us. So she's going to hopefully help make my day that much more effective and get me into more impactful situations and get me out of some of the things that I don't have a lot of impact in. So super excited for Catalina to join us.
Yes.
It's like drinking through a fire hose around here, but Cory, you should see this. Let me show you this. Did you see this?
I did.
we created, Sam and Luke created this. I think it's almost 100-page binder for her. It's a playbook of all things Falcon Wealth Advisors. So I'm super excited. Credit to Luke, credit to Sam. We're up at our game. So she's got this welcome binder that has a lot of the playbook into what her standard operating procedure is, our culture, different groups and what they do. So I'm very excited to have her join us. Hopefully we can get her acclimated very quickly. Cory, I know you had something on here. You wanted to talk about Trump coin.
Yeah, let's talk about it, Jake. What do we think about Trump coin? What do you think?
I don't know much about it. I thought it was a joke, but I guess there's this Melania coin too, right? His wife.
That's right.
So again, I am not a huge. This is the reason, actually. One of the reasons I'm not a huge fan of crypto. So you and I were talking about this earlier today. I guess the Trump coin shot up in value and then it crashed.
Correct.
Maybe the same for Melania's.
I'm not sure what it's done since, but yes, you got it.
Here's a problem, guys. Here's a problem to our audience out there. I don't want our audience putting serious or any money really into any coins, because you can see how volatile the pricing can be, and there is no it's called intrinsic value. And I want everyone to remember this. Everyone that's listening to Upticks or watching should remember what intrinsic value is after today's show. Intrinsic value is basically a makeup that if you can actually produce a good or service, that there's real earnings potential or power behind your offering. When you have a coin, you can think of the opposite of intrinsic value, Cory, is literally just what somebody's willing to pay for it. Meaning, if the price is higher or lower, there's nothing internally that made that asset more valuable. It's what I've called in the past, what the last sucker is willing to pay for it. And you don't want to be that last sucker, and you don't want to invest in this stuff. It's just, I think it's silly. What do you think, Cory? That's my little
I'm right there with you. I think along the same lines, Jake, but I have been thinking about this bigger picture, right? What does this mean for cryptocurrency? And what I think is interesting about this, Jake, is exactly what you just said, which I feel like it sort of reveals the scam, for the lack of a better term, in it, Jake, which is that, like, if you and I just created a new form of money, does that mean that we get 100% of it?
I guess so. I don't know.
Basically what happened here. But I guess exactly to your point, like, I just don't know if the real issue is the intrinsic value, right? It's really, this is just wealth accrual that's divorced from any sort of actual value that's being created for anything. It's just the idea that someone created money and someone else can get rich too. I think that it is really fascinating and interesting. And I think that people need to be careful, exactly like you said. And remember that when it comes to investing, it really is about investing in actual value, not hype.
Yeah, and I don't think you should align your investments with your politics or your religion, for that matter. I don't think you should. I think those are, now you can have certain causes that you believe about, and maybe there's certain companies you don't want to put your money in, and that's fine. But I don't think you should be, whether you like Trump or don't like Trump, I don't think you should be buying some cryptocurrency with his name on it. It's stupid.
Right. And a way to get rich without contributing anything to society and just making up money. And all you really need to do is convince the next person they're going to get rich too. It's fascinating, but I think it's all the more reason that people need to be careful.
That's a problem though, Cory. That's another side issue here, is that's the problem with society today, is there's too much cash sitting around that people don't know what to do with it, that they're willing to buy these silly coins that pop up out of nowhere. And so if you got that kind of cash, give us a call.
That's right.
We'll tell you how to invest it.
That's right.
Because we don't want you throwing it away. We certainly don't want to see anybody lose it. All right.
Okay.
Move on, Cory. Way to make it political. Way to go, Cory.
Well, you got to talk about it. You got to talk about it.
What are you talking about? All right, let's do it. Let's play ball then. Let's put some headlines. What do you got?
All right, Jake. How you can see through Wall Street's ritual of wrong.
Yeah, I think I've talked about this on an earlier episode, Cory, but they do this every year. People, analysts, economists, financial advisors, you name it. If you're in the markets, you see these market forecasts out here all the time. And basically this article talks about that their predictions by analysts and strategists are frequently, they miss the mark often, which sadly will lead to misguided investment decisions.
Yep.
And so the article talks about focusing on long-term investment strategies rather than short-term market predictions. So I'm the pro, you're the con on this one.
All right.
And the pro is basically saying, don't subscribe to this ritual of wrong. Okay, that's the pro side. So the reason you don't want to do this is it encourages investors to adopt a long-term perspective, which can lead to more stable and potentially higher returns, meaning you're not getting caught up in a year-to-year, quarter-to-quarter, month-to-month predictions. You just focus on that long-term plan.
But if you're ignoring on the other side of that, though, Jake, if you're ignoring short-term forecasts, you might miss out on short-term gains.
Yeah, I guess if they're right, you're right. It could be if if the economist gets lucky and gets it right. But I'd argue another reason not to do it is you have reduced stress levels. By not fixating on short-term market movements, investors can avoid the stress and anxiety
Mm.
associated with market volatility. So that's another reason not to be subscribing to this. What's another
Mm.
reason, a con here, Cory?
Yeah, oversimplification. Long-term strategies are generally beneficial, but they might not account for significant market shifts that impact portfolios.
Yeah, so the old adage, this time is different or new.
Mhm.
We've never seen anything like this before, Cory. We got to do something different.
Yeah. Every day is new and different. We've never
Good
seen
one.
any day before, right?
Right. By definition, every day is new. By definition, there's never been this day. This day is the newest day we've ever had.
And
And
it's the only it's the only one we're gonna have.
we've never had one like this ever. So that's good though. I'm glad that you did bring up the cons. But again, for us, we don't get caught up in this. In fact, you know what helps me, Cory?
Let's hear it.
This type of year, actually, my reading goes down a lot on financial press because when I see predictions and blah blah blah, I don't even read it because
You don't read all those charts?
no, I'm not. No, I don't. Because I'm that lasered in on my time and my focus. I'm like, why do I want to spend 5 to 10 minutes reading about some bozo's market prediction that they're probably going to be wrong about anyways? Well,
Yeah.
why would I spend 5 minutes doing that? Why would I ever do that? So, again, I want to encourage our audience: don't get caught up in the hype. Keep that long-term focus. Yeah, we're going to be aware of what's going on. We know who's in presidency. We know what's going on with the Fed. Like, we're watching all earnings. We're watching all that stuff.
Even
But
Trump
again,
coin.
don't want to do Trump coin. But again, you want to keep that
Yep.
focus, maintain that focus. All right,
Good.
Cory. Let's move on to the next one here.
Ah.
The 60-40 portfolio isn't doing its job. It may be time to ditch bonds, Cory. You want to ditch bonds?
Let's find out. So, first
Sure.
off, Jake, how many times do you think that we have seen a variation of this headline? Because I have lost count.
Yeah, let me define it for our audience real quick. So what the headline is
Please.
talking, yeah, the 60-40 refers to 60% in stocks and 40% in bonds as supposedly the standard or the model portfolio. Now, some of our clients may be allocated that way and some may not. We do it based on your financial plan, but there's an argument that this is a decent model is really what the article is
Yeah.
alluding to. Go ahead,
So,
Cory.
yeah, Jake. So the researchers in this article were suggesting that bonds don't help a retiree and offer little to no value. And Jake, that investors should swap bonds for annuities in their portfolios.
Whoa.
And the reason I wanted to talk about this today, Jake, is because annuities have been marketed as the solution to seemingly everything, at least in my career, in the 15 years almost now that we've worked together. And now an annuity is a solution for a diversified portfolio. My opinion is that this is why people need a plan, not a product. But for the sake of the show today, I do think let's talk about the pros and the cons of the 60-40 portfolio. And Jake, I'd like to talk about the pros and the cons of the alternatives that were suggested in this article as well.
Wow, Cory, you always got to bring the long one. All right, so
I think
I'm
it's
gonna
good to talk through.
I'm going to be the con of against the 60-40 portfolio. Now, again, for compliance purposes, this is not where Cory and I, even though Cory's saying the pros, he is not recommending anybody be in this allocation. He is recommending your allocation be aligned with your financial plan. I want to be very clear with that. But go ahead, Cory, go to a pro.
Yeah, absolutely. So one of the pros of the 60-40 portfolio, Jake, is diversification, balancing growth, potential of stocks with stability of bonds.
Yep. And a con is you may be too conservative. So again, lower returns because you got 40% in bonds in this example.
Yeah, that's exactly right. And I think though the other side, the pros, right, reduce volatility. Historically, there has been less volatility than a portfolio that's invested 100% in stocks.
Yes, Corey, but this says that when bond prices drop, when interest rates rise, so you've got interest rate risk. If rates keep going up, those bonds will lose value.
But income generation, the bonds are paying income and providing interest payments with, especially folks who are retired, taking distributions, living off their portfolio. That income generation is really valuable.
Yep, and the last one maybe what's a common flaw actually is recency bias.
Mm.
Recently in history, when stocks go up, bonds go up, and when stocks go down, bonds go down. So there is a higher correlation as of recent years. I wouldn't say that's over long term, but recent.
Right. So if we just pause there for a moment, Jake, right? We talked through the pros and the cons of the 60/40 portfolio, diversification, reduced volatility, of course, lower returns if you're not invested aggressively, interest rate risk, et cetera. But what I think we need to talk about here too, though, Jake, is just we need to run through the pros and the cons of the alternatives that this specific article suggested. Because, Jake, the alternatives were an higher allocation to international stocks, annuities, private equity, peer-to-peer lending, all kinds of stuff. So I just want to talk through that, especially if those are being posed as alternatives here. And I'll take the pros here, Jake. So the one side, one benefit to something different would be in higher allocation to international stocks, according to this article, because that diversifies geographic risk and provides the potential for higher growth.
Yeah, con of doing this is you've got to understand currency risk, right? So what does the
Mm.
dollar fluctuate against these international investments, and then political and economic instability in foreign markets, right? So if you get too crazy with it, and you've got some sort of upheaval in the other country, you got to be
Mm.
aware of that.
So there's pros and cons, just like there is with the 60/40 portfolio. And how
That's
about
right.
annuities, though? Annuities, those can provide a stable income stream, Jake, and reduce reliance on market performance for retirees.
Yeah, but again, everyone on the show knows if you're first time listening, we do not like annuities. They're complex, their fees can be very high, and it can cost you money just to get your money back. So we
Mm.
don't like them.
Yeah, that's true. That is true. But another alternative, Jake, one that's exciting for people right now is real estate. Right? Real estate, it can generate rental income, potential for property value appreciation, something different than the market.
Yeah, again, it can require significant capital though to buy some real estate. And then there's property management core. I don't want to be unclogging toilets.
Yeah, that's fair. That is fair. How about commodities like gold? It hedges against inflation. It does provide diversification as well.
Yeah, we talk about gold not having intrinsic value either, like this cryptos, and it can be volatile in price. And there's no income, there's no dividend from gold.
Mm. So if the 60/40 portfolio that we've talked about here, Jake, then what about private equity, right? That's exciting for people. It's something we hear a lot about. That is an alternative. And a benefit to private equity is that it can provide higher potential returns and access to unique investment opportunities.
Yeah, but a lot with private equity ties your money up for many, many, many years. So it's illiquid and there could be high minimums, or you might even have to be an accredited investor, which not everybody is.
Maybe it's peer-to-peer lending then, Jake. That's the other alternative that's posed. Peer-to-peer lending diversifies risk, potential for higher returns than traditional savings.
Yeah, and there's a credit risk. Like, who are you loaning this money to? And it's not really regulated. So you could get caught up in some sort of scam if you're not careful with that peer to peer lending.
That's very good.
Man, these are a lot of different. Wow, there's 6 different options here, Corey. Now,
Alternatives
now,
to a
one thing we
60/40
do,
portfolio.
I do suggest that international for certain clients can play a role in the portfolio.
Mhm.
Commodities, even maybe even real estate. But so, what's your take on this? So, what are you saying?
My take on this is that there's pros and cons to everything. I think
Ah,
the recency bias, Jake, that you brought up is huge, and really the fact that I mentioned when I started talking about this headline that I really do, I truly have lost count of how many times I've read some variation of that same headline, Jake, just in the time that we've worked together, and that I think it is, sometimes there's the idea that people need to do something different or should change something when oftentimes the best thing to do is nothing at all.
I like that one, Corey. It's a good point. And you're right. Don't go chasing the latest fad in investing. Um, Now, here at Falcon Wealth Advisors, we're not going to sit on our hands. We're always looking for, to upgrade
Of
our
course.
process or whatever we're doing. But we're also not silly enough that we're going to go just chase whatever's new and shiny object is out there. So you don't. The key here, and I talked about this last week on our show, Corey. The key here, if you don't need private equity to hit a home run
Yep.
for your financial plan to work, then why are you doing it? I think that's really what this boils back down to. Like, You don't need a lot of that stuff. You don't need real estate, maybe. Maybe you don't need, and again, this is not advice. I'm just saying, like, you have to determine what do you need to happen for your financial plan to work. And what I mean
Yes.
by what do you need to happen? What rate of return do you need to make? Do you need to make 4%? Do you need to make 7%? Do you need to make 8%? What is it? And then what we do at Falcon Wealth Advisors is we construct a diversified portfolio that's hopefully designed to help give you a good chance of hitting that target rate of return. And we try to mitigate that risk as much as possible. The good point here, Corey, all these pros and cons, there's risk with anything, even the annuity.
Everything.
There's
Yep.
risk with everything. And so I like that, Corey. I'm glad you shared another long one for us. But I think it's important for people to know don't go chase the shiny new object, and just figure out you need to figure out what rate of return your financial plan needs to grow at in order for your goals to work, and then you need to invest aligning that with those goals. That's that simple.
That's right, Jake. And I don't know, frankly, how many people that watch or listen to the show read the Wall Street Journal with any regularity. But the reason that I think it's important exactly for us to talk about beyond just what you've described here is the fact that if the Wall Street Journal is suggesting that a 60-40 portfolio doesn't work and it's time for people to ditch their bonds, that's obviously a meaningful investment change and a meaningful portfolio change. And what I would point out, though, is that, yes, these stories need to be run, information needs to be published, but it does not mean that everybody needs to act on everything that they read or see.
Right. Right. And you know what? I'm a younger guy. I'm a fan of bonds. Some people call bonds, boring bonds.
Mm.
I don't see it that way. I don't see it that way. I think bonds play a very important role in a portfolio, and now is actually recently is a pretty darn good time to buy bonds compared to where it was 4 years ago, 5 years ago. So, again,
True.
this none of this is investment advice, but my point is, it's really weird that the Wall Street Journal is suggesting that you ditch bonds now when you can finally get
Right.
4 or 5%, when for years you could only get 1 or 2%.
Yeah, I don't know if now is the time for the peer-to-peer lending and the and everything else that's described in the article, but that's exactly right. So,
Yeah.
and I appreciate, Jake, that you made the comment that you're a younger guy, because I think that kind of parlays nicely into our next headline,
Yeah.
which is around people on the other end of the spectrum, right? And I'm
Do it.
glad you included this. So the next headline we've got here, Jake, is the financial regrets and wisdom of Americans over 80 years old.
Yep. So another Wall Street Journal article, Corey, they discuss the financial regrets and wisdom shared by
Mm,
seniors over the age of 80. The article highlights that many seniors wish they had started saving earlier and
mm,
invested more aggressively when they were younger. So hear this, millennials and Gen Zers or whatever it is out there. They also regret not seeking professional financial advice sooner,
mm.
credit to Falcon Wealth Advisors, and emphasize the importance of having a diversified portfolio. Additionally, the article, Corey, underscores the value of maintaining a budget and living within one's means. So I'm going to go into the pros of doing basically what these 80-year-olds are suggesting, Corey.
Okay.
Number one, especially, hopefully everybody listening to this lives into their 80s and beyond. But if you do that, compounding is on your side. So starting early allows for more time for your investments to grow, and you can build a substantial nest egg. Look at Warren Buffett out there. Credit to Warren Buffett. Corey, you mentioned him on an episode. Guy's in his 90s, got a lot of money. He didn't have that much. He had a lot of money, but he didn't have as much as he does now when he's in his 60s. And the reason is compounding. Good. What's a
Mm.
con?
What about missed opportunities? Well, although I feel like this might be supporting what you just talked about, Jake, which is that, not starting early or investing aggressively can lead to missed opportunities for growth.
Yep, yep. So that's good. That's kind of doubles down on what I said. So,
Yep.
professional advice, Corey. So again, we have, and again, this is tooting our own horn a little bit, but we meet with people in their 20s and 30s. We meet with people in their 80s and everywhere in between. I mean, we do specialize in people at or near retirement or people that make high incomes. And whether it's saving them money from tax planning or telling them that they're not putting enough in their 401k or doing a
Mhm.
backdoor Roth or whatever that may be, just seeking an advice, a professional that's looking at this stuff every single day. I mean, this is what we do. In fact, we have a team around us we have 5 financial planners. That's their jobs, is to look at financial plans every day and to look for opportunities to enhance our clients' financial plan. So again, of course, I'm going to say this because I do this for a living, but it can pay to work with a competent wealth advisor that can help you.
But the cost of that advice, the professional financial advice, Jake, comes with costs or with fees, which might be a barrier for some people.
Yeah, it's not free. And if any advisor's telling you it's free, then I wouldn't work with them because they're full of it. It does cost money to engage with a professional. So you've got to weigh that. Is their advice worth the cost? And then
That's
the
right.
last piece that talked about Cory just being diversified. There are people out there that have gotten very lucky for being concentrated in their investments, but it's not something I would recommend. There's a lot of people that have gotten very wealthy from being diversified. So again, I do not recommend concentration as a financial planning strategy because you can really mess things up if things don't go your way.
Now, you mentioned this earlier, though, in one of the cons, and I think that the people interviewed highlighted too was the budgeting challenges. Maintaining a strict budget can be difficult and may require significant lifestyle adjustments.
Yeah, it's not easy, right? Especially if you're younger and starting a family. You know this, babies aren't cheap. So it might be hard to stay to budget or save. Or maybe you retire and you didn't have as much as you thought saved and you're slowly
Mm,
depleting your nest egg. So I get it. The key here, though, I want to talk about budget with you a little bit, Cory, because your next one's
Good,
another long one, isn't it? Gosh, you
good.
brought another long one on.
It's a good
So
one.
teaser. Yeah, no, you got to tune in next week. Cory's got another long, lengthy one.
Long
Where's your
article to
chart?
highlight.
You didn't bring a chart this week either. But anyways, so budgets. Budgets are often a cause of stress, are often a cause of arguments, are often a cause of anxiety, maybe even depression. So
Mm,
I don't want to take that budget comment you made lightly, Cory. Here's the deal. I'll give you a tip here. From my experience, again, I've almost been doing this 20 years. There's two types of people that have successful budgets that I've met with, Cory, and I'd love to hear your comments. The one type of person that I see has a successful budget, believe it or not, they don't have one. And that might sound stupid, but not that they're stupid, but am I like what are you saying, Jake?
sure.
Well, my point is they live so grossly below their means that a budget is not necessary for these people. Meaning, maybe when they were working, Cory, they were bringing home 10 grand a month, right?
Okay.
And they were only living off of 4. So they never had a budget, right? Because they were building up their savings every month. And you know what? Now that they're retired, they've got so much money that they're not even every time we meet, their portfolio is growing faster than they can spend it, right?
Yep.
That's the one type. And good for them. Credit to them. You know why those people are like that?
Why?
They did not let lifestyle creep affect them as they made more money in their career, which is very fascinating. So a lot of people are a victim of lifestyle creep, meaning you make more money, you buy a nicer house. You make more money, you buy a nicer car. And just as you keep getting raises, you just keep going up and up and up and up. A lot of those people I've seen, Cory, they live the same as they did in their 50s and 60s as they did in their 30s and 40s.
Mm,
So lifestyle creep is a real thing you got to be careful of. Now, the second type of people that have successful budgets are meticulous in their record keeping. You know who I'm talking. You smile. You know who I'm talking
I
about.
know exactly who you're talking
These
about.
these are the spreadsheet people. These are the people using our financial planning software, eMoney. These are people who still balance their checkbook. You balance your checkbook, Cory?
Not anymore.
Not anymore. And there's nothing wrong. Or these people are the ones that have very firm rules. We don't
Mm,
buy anything unless we can pay for cash. We have no credit cards. All our cars are paid off. Our house is paid off. Like, so again, they're very strict in their budget, but they're not stressed about it, right? So it's a different thing. You can be strict and firm with your budget, but it doesn't cause you any stress. Then that's okay. That's healthy, right? So my point though is if you're not one of these two people, my advice to you, Cory, or anybody listening, is to check in with yourself and list out your values. I'm talking faith, family, healthy food, exercise, whatever it is, right? Relationships, whatever they're unique to you, whatever they are. List out all your values and then track your spending for 3 months. And then you need to match it. Does that spending match that value?
mm.
And that's the quickest way to get your budget back aligned. If it's still not aligned after that, then I would highly encourage you to book a meeting with our planners at Falcon Wealth Advisors, and they can get a little deeper with you. But I think the place to start is to make sure you're spending money where you value it. Because if you say you value health, Cory, but then you're spending, I don't know, $400 a month going out to eat, do you value your health?
Right. Yeah, unless that's a really healthy restaurant I'm going to over and over and over.
And maybe that is, and that's okay, right? But I mean, then you need to go deeper. Then you say, okay, yeah, my grocery bill, Jake, is $800 a month. Okay, well, what are you putting in your body, and is it healthy? Is it aligned with your health
Like,
needs?
Jake, these cigarettes are getting expensive. I'm just kidding. But it's like, to your point, right? Making sure that these things are aligned. It's important. It is.
Yeah.
And if something's not aligned, like, that's where I think the incongruency that people feel, at least speaking from my own experience, Jake, from someone that has worked through understanding budgeting and cash flow and making all of these things work for myself. Because again, I think, that wasn't just some inherent knowledge that I had either, Jake, is that it's really just a matter of shining a light on it and figuring out what really
Yes.
matters and what's important to you.
Yes, they say awareness is key, and that's what I'm getting at here. Let's get some awareness.
Good.
So good. That's a good last topic there, Cory, the budgeting. Because I know it's not easy for everybody. I see it, Cory. I've met with people. It's not easy. So I understand that, and I'm empathetic to that. But I'm telling you, there's help. Like, if you're a client of Falcon Wealth Advisors and you have problem, if you're fighting with your loved ones over your spending, or if you're stressed, let's talk about it. Let's get in.
Right.
Get in.
There doesn't need to be shame in it.
Right. Get an appointment with our financial planners, and let's use some tools to get that turned around, because I don't want anybody out there. I'm not stressed about my budget. Are you?
Nope.
But you know why? I did a lot of work on it.
Correct.
Did a lot of work on it.
A lot.
I talk about it with Rachel.
Yep.
Right.
And you talk about it with the financial planners, just like I do.
Yeah, I think I have my meeting. I don't know if it's this week or next week. I as coaching, I asked them to review with me, and I challenged them. But yeah, we look at all those things. I do it too. I'm eating my own cooking here. Like,
Yep.
you gotta check in on that, and you gotta have a healthy conversation with your spouse or your loved ones about it.
Yep.
And if there's some if there's some issues, you got to address them.
Right.
You got to address
They won't just go away on their own.
Right. Right. All right. Good, Cory. That's a great way to stop. Thank you so much for joining me this week. Thank you to everyone tuning in. Please like and share our content. Give it a 5 stars, thumbs up. And Cory, go Chiefs.
Go Chiefs. Bring it home.
All right. Thank you. Let's have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.